Welcome to This Explainer. If you're a BS accountancy student grinding through your second or third year, I know exactly what you're dealing with. The pressure is absolutely on. We aren't just cramming for a quiz tomorrow. We're building mental models designed to lock this knowledge into your brain for the next 3 years. That way, you can effortlessly crush the Management Advisory Services part of the LCPA. So today, we're hacking a highly tested, high-yield topic, special sales orders.
Okay, here's our study roadmap for today. First, mastering special sales orders. Number 2, sorting relevant from irrelevant costs. 3, avoiding the capacity constraint trap. 4, factoring in opportunity cost. 5, solving actual board exam scenarios. And finally, number 6, a rapid-fire LECPA bullet review. Let's get into it.
Section 1, Mastering Special Sales Orders. Examiners absolutely love this topic. Why? Because it forces you to drop your standard accounting habits and start thinking like a true strategic manager. Just looking at the definition, a special sales order is a non-routine, one-time only deal, usually priced way below the regular retail rate. This means our normal pricing rules, you throw them right out the window. Normally, you'd price a product to cover every single cost, variable, fixed, administrative, and then slap a markup on top, right? But imagine a foreign distributor suddenly offers to buy thousands of units at a massive discount. Your knee-jerk reaction might be, no way, that's way below our cost. But actually, as you'll see in a minute, saying no could cost your company some serious profit.
Section 2, relevant versus irrelevant costs.
Before we can even think about pricing one of these special orders, we have to cut through the noise. What costs actually matter? When you're sitting in that exam room, cognitive load is literally your worst enemy. Your brain needs a lightning-fast filter. The key here is to automatically flag future differential costs as relevant while totally ignoring past sunk costs. Relevant costs are all about the future. How do they change based on your decision? For example, if a brand new special shipping fee only kicks in because you accepted the order, that's a differential, out-of-pocket cost. It matters. But a sunk cost? Think about the depreciation on a factory machine you bought 5 years ago. That cash is long gone. It doesn't change a bit whether you take this new order or not. Which brings us to a huge time saver. Listen, when you're taking the exam, I want you to physically draw a line straight through general allocated fixed overhead on your test paper. General factory rent, executive salaries, standard depreciation, none of these change whether you accept the special order or not. By crossing them out right away, you kill the visual distractions and stop yourself from accidentally adding them into your minimum price math. Section 3. The capacity constraint trap.
Okay, this is where so many students drop easy points. They get hyper-focused on the costs and totally forget the physical limits of the factory. This is a binary fork in the road, and your brain needs to spot it instantly. If your factory has idle capacity, meaning you've got machines just sitting around gathering dust, taking on a special order doesn't disrupt your normal business. You just have to charge enough to cover your extra incremental costs. Simple. But if you're maxed out at full capacity, taking that special order means you're literally stealing production time from your regular, high-paying customers. So you have to charge this special customer enough to cover your extra costs, plus compensate for the profit you're losing from your regular sales.
If you memorize this simple 3-step mental model, you'll systematically destroy any special order problem without getting bogged down by useless data. Step 1. Always check capacity first. Are they idle or maxed out? Step 2. Isolate the purely incremental variable and specific fixed costs. Step 3. Only add in an opportunity cost if Step 1 told you they are at full capacity. That's it. Section 4, factoring in opportunity cost. Let's zoom in on that third step for a second, because messing up opportunity cost is a classic way to fail these questions. Opportunity cost might sound like some abstract concept from Econ 101, but in management advisory services, it's a very real, hard number. The definition here is the benefit foregone when you choose one option over another. So when you're forced to give up selling a highly profitable regular unit just to fulfill a discounted special order, that lost contribution margin becomes a real cost, and your minimum acceptable price has to cover it. You're not just losing revenue, you're sacrificing the selling price minus the variable costs of those regular units. Forget this, and you might accidentally accept a special order that drains the company's net income.
Section 5, solving board exam scenarios.
All right, let's put these cheat codes to the test with an actual scenario pulled straight from your review materials. Meet the Swifty product. Take a close look at the data. We've got standard variable costs, a tricky fixed overhead distractor, and a brand new incremental shipping cost. Let's run it through our filter.
Direct materials, labor, and variable overhead, those are relevant variable costs adding up to 30,000 pesos. That's 6,000 pesos in fixed overhead, irrelevant, general cost, cross it out immediately. And the 5,000 pesos special shipping, that's a specific, incremental, out-of-pocket cost, so we keep it.
Now, watch how the logic splits based entirely on our capacity check. If we have excess idle capacity, we aren't disrupting our regular sales. We just need to cover our 30,000 peso variable manufacturing costs plus that 5,000 peso special shipping fee. That sets our absolute floor price at 35,000 pesos. But what if we're at full capacity? Now we have to factor in the lost contribution margin. A regular unit sells for 40,000 pesos and costs $30,000 to make. That means we lose a 10,000 peso contribution margin for every regular unit we sacrifice to this special order. So at full capacity, our minimum acceptable price slams all the way up to 45,000 pesos. We're combining the 35,000 in incremental out-of-pocket costs with that 10,000 peso opportunity cost. If you quote this special customer a single peso less than 45 grand while at full capacity, the company loses money. It's literally that straightforward. Now, you've got to watch out for this classic examiner's trap. Let's check out this jewelry bracelet scenario. Notice how they combine variable and fixed costs into that single 700 peso overhead figure? They're totally baiting you to mistakenly include the fixed portion in your minimum price. The prompt usually drops a hint like, most of the manufacturing overhead is fixed. If you just grab that 3,000 peso total unit cost as your baseline, you've already lost. You absolutely must strip out that fixed portion because, as we just learned, it's completely irrelevant. And here's another massive pro tip for your board exams. If a special order comes directly to the factory and totally bypasses the regular sales team, you have to subtract those saved variable selling commissions from your cost baseline. For example, if you normally pay 2 pesos in variable selling expenses per unit, but this special order doesn't use the sales team, that 2 pesos becomes an avoidable cost. And avoidable costs are relevant. You literally just subtract that from your total variable costs when calculating your absolute minimum price. Section 6, LECPA Bullet Review. Okay, let's log all of this into your long-term memory with a high-speed review of the absolute non-negotiable rules. This is the exact mental checklist you need right before you sit for the boards. Honestly, take a mental screenshot of this. Relying on these precise bullets will drastically lower your cognitive load. First, always check capacity status. If it's idle capacity, cover incremental costs only. If it's full capacity, cover incremental plus opportunity costs. Ignore general allocated fixed overhead. Do include specific incremental fixed costs, like a special tool bought just for this order. And finally, sunk costs are completely dead to you. Let me leave you with one final thought to challenge how deeply you've mastered this framework. If a special order requires purchasing a new, one-time use design tool, does that tool become a relevant incremental cost, even if the factory has massive idle capacity? Think about how direct specific fixed costs behave compared to general overhead. Understanding that subtle difference right there, that's what separates average students from board passers. Keep practicing these mental models and you're going to absolutely crush the LECPA.